We'll be covering 1. The language of business, 2. 3 fundamental accounting assumptions, 3. Cash versus accrual accounting, 4. Qualitative characteristics of accounts, and finally, 5. The big picture.
Okay, let's kick things off with Section 1, the language of business.
Okay, let's dive into this. To really appreciate all these accounting rules, we first have to introduce the ultimate villain of the business world, financial confusion. I mean, just imagine this scenario for a second. You're a business owner, right? You take all your receipts, your invoices, your bank statements for the entire year, and you hand exact copies of those records to 5 different accountants. You ask them to simply calculate your profit. Well, a few days later, they come back and hand you 5 radically different profit numbers. One says you made an absolute fortune. Another says, nope, you're bankrupt. And the other 3 are just scattered somewhere in between. Can you imagine the utter chaos this would cause? Like, how could you ever secure a bank loan or pay your taxes? It would literally be a complete disaster. So, to prevent this exact disaster, the financial world relies on something called Generally Accepted Accounting Principles, or GAAP. Think of GAAPs as the vital backbone of the entire accounting information system. They are the conceptual framework, the ground rules, developed specifically so we can avoid that nightmare scenario of getting 5 different profit numbers. They define the parameters and constraints for generating financial reports. And because of these standardized rules, financial statements prepared by totally different organizations can be universally understood. Honestly, without them, the whole system couldn't even stand up straight.
Moving right along to Section 2, 3 fundamental accounting assumptions. Underneath all those complex calculations, there are 3 core pillars. We have going concern, consistency, and accrual. And you know what's really interesting here? These 3 are essentially the default settings of the business world. If you pick up a company's financial statement and nothing is explicitly written about these assumptions, well, it is automatically assumed by law and practice that these 3 rules have been strictly followed. Let's break them down. First up is the going concern assumption. Basically, this principle dictates that a business is going to continue operating into the foreseeable future. We just assume the enterprise has neither the intention nor the need to liquidate. So why does this actually matter? Well, say you bought a massive piece of heavy machinery for $500,000 and you plan to use it over 10 years. If you tried to sell it tomorrow, you might only get $300,000 for it. But because of the going concern concept, we completely ignore that short-term drop in liquidation value. You're not selling it tomorrow, you're using it to generate future benefits. Now, the flip side of this is absolutely crucial. If a business is facing immediate liquidation, like so many sadly did during the recent pandemic, the going concern assumption is broken. And that sudden change absolutely must be clearly communicated to stakeholders so they aren't misled.
And this brilliantly illustrates our next assumption, consistency. If going concern ensures we look to the future, consistency ensures we can accurately look at the past. Consistency simply means that once you pick an acceptable accounting method, say your specific method for calculating depreciation, or how you value your inventory, you have to stick with it from one year to the next. You can't just flip-flop and change your rules every single year just to make your profits look better. By maintaining this consistency, business owners and investors can actually compare a company's performance year over year and know for a fact that the growth or the decline is real and not just some clever mathematical trick. All right, that brings us to Section 3, cash versus accrual accounting. To really grasp this final assumption, accrual, we need to look at a real-world example straight from our source material. Let's look at Mr. JD's clothing business. Okay, so he buys $50,000 worth of inventory, but he only pays $20,000 in cash up front. He then turns around and sells that clothing for $60,000, but he only collects $50,000 in cash today. The rest of that money is still owed to him. Now, what's really interesting about this slide is how easily the truth can be distorted depending entirely on the lens you use. If Mr. JD simply looked at his bank account, which is what we call the cash basis, he'd see $50,000 collected from customers minus the $20,000 he paid out to his supplier. That leaves him with an apparent $30,000 profit. But here's the catch. That $30,000 is a highly misleading illusion. It's based purely on the timing of cash moving around, not the actual business activity. Under the accrual concept, we find the true reliable profit, and that is exactly $10,000. Why? Because accrual demands that we match the total revenue earned, the full $60,000 sale, against the total expenses incurred to actually get that revenue, which was the $50,000 for the inventory. That leaves a true profit of $10,000. The physical cash flow simply doesn't dictate the success of the actual business operation.
So, to summarize, the accrual concept means recognizing the effects of transactions when they actually occur, not just when the cash is received or paid. This pairs perfectly with the matching concept and the periodicity concept. Honestly, it is the very foundation on which the entire structure of present-day accounting has been built. It ensures that when we look at a specific accounting period, we are measuring true income, true assets, and true liabilities. Let's move on to Section 4, Qualitative Characteristics of Accounts. Once the numbers are actually on the page, there are 4 qualitative characteristics that polish this information and make it truly trustworthy for decision makers. They are understandability, relevance, reliability, and comparability. Now, understandability requires that the information is, well, readily understandable by users, assuming they have a reasonable basic knowledge of business. But keep in mind, information about really complex matters shouldn't be excluded just because it's difficult to grasp. If it's relevant, it absolutely must be included. And speaking of relevance, we have to talk about materiality. Materiality provides a really vital cutoff point for accountants. Basically, information is considered material if leaving it out or stating it incorrectly could actually influence the economic decisions of a user. Think about it this way. If a multi-million-dollar corporation makes a $10 error in their stationery budget, that is not material. It's not going to change an investor's mind. But a hidden million-dollar debt? Yeah, that is highly material. Materiality ensures we focus the spotlight on the information that's actually significant enough to impact choices. Next up, for these numbers to be completely reliable, they must have neutrality. This means the information contained in the financial statements has to be entirely free from bias. Management can't just cherry pick or present information to influence a decision or force some predetermined rosy outcome. The numbers have to tell the true story, whether it's a story of triumphant success or, a story of a really tough financial year. Notice how neutrality interacts with our last characteristic, prudence. Look, business is full of uncertainties, right? Will a client actually pay their bill? Will a factory machine break down? Prudence requires a healthy degree of caution in these uncertain conditions. You don't overstate your assets, and you don't understate your liabilities. So, the crucial point is, the source material makes a brilliant distinction here. Prudence absolutely does not allow for the creation of hidden reserves or deliberate excessive understatements just to play it safe. Doing that would violate neutrality. You'd be artificially manipulating the numbers, making them totally unreliable. Prudence is about honest caution, not deception. Finally, we arrive at Section 5, the big picture. Wow, we've covered a lot of ground today. We started with that terrifying scenario of 5 accountants giving you 5 totally different profit numbers. But because of GAAs, because of those silent assumptions of going concern, consistency, and accrual, and because of the rigorous demand for neutrality and materiality, we completely avoid that chaos. These standardized concepts are literally the only thing keeping the global business language transparent, comparable, and reliable. So I want to leave you with this final provocative thought. The next time you're reading up on a company's success story, or maybe getting ready to make an investment, ask yourself, what silent assumptions and careful rules are holding up those numbers? Without them, how could you ever trust a financial decision again? Thank you so much for joining me today to decode the language of business. Keep learning, stay curious, and I'll see you in the next explainer.